Greetings and good afternoon to everybody out there. I know it's been a little bit of time since we've done a big public webinar, but welcome back to everyone that actually does enjoy signing into these and listening to the words that prattle on out of my mouth. My name is Damon Richardson, and I am the renovation lending specialist here at Wholesale. Today, the 14th of December, we are going to once again talk about one of my two favorite topics, and that topic is the HomeStyle Renovation Loan Program and how we run it here at Remin. I know that it is approximately 2 minutes after the hour. I just want to give a couple of people some an opportunity to get logged in prior to kind of kicking everything off. So just bear with me a moment. I'm just going to double check on a couple of people that needed to get logged in. I just didn't want anyone to think that we were captainless or on this voyage and really without having our vessel in order. So give me 1 second to check on that. Also, let's use this time as a little bit of an audio check. You all should be able to hear the words that are emanating from my throat here. So if anyone's having a hard time making out my audio, please submit a question to the question panel, and I'll know that if I see significant amount of questions, that there's something here on my end. But if there's only one or two of you, I know it's kind of one of those, it's not me, but it's you kind of deals. But either way, we just wanted to make sure that we have everything lined up and working correctly. Well, in terms of audio, I can see that we don't have really an issue going audio-wise, so that makes me happy. Now just give me 2 minutes, and at approximately 3:05, we will begin the presentation. All right, everyone. I believe that that is everyone that I can possibly think of that sent me an email that had a hard time. I think I've helped them all. So at this point, it's time to set our sights back on the task at hand and to get into talking about these programs so that you can actually have a good basis of understanding for how they work and what we are going to do in terms of being able to help you navigate the world of submitting and closing renovation so that you can kind of see all of the things that we do and hopefully get a good understanding of what happens behind the scenes here at Remin so that you can understand why our program is as fast and as flexible as it actually is. But before we can get into all of those immediate and soaring highlights, we have to start at an area that I like to call literally the beginning. All right, there was a time frame in renovation where selling home styles, or well, back then it didn't even exist if you're going back into the 90s, but Going back to the 90s, the early 2000s, selling renovation lending really meant selling borrowers on the idea of actually doing renovations. It was a much different time for consumers than the times that we are facing right now. We didn't have this thing on TV that is literally called HGTV, which has basically turned every single adult over the age of 25 into a person that is taking their advanced major or minor in home renovation, because every Friday, Saturday, Sunday, they are sitting there by the tens of millions watching shows all featuring creating home renovations, but most importantly, learning about real estate, learning about how doing renovations passes on the savings generated by renovation projects to the actual consumer, which creates a situation where they are saving money on real estate. So with that knowledge, I want you to understand that you no longer have to sell the idea of renovating to anyone. The marketplace has already woken up to it. 2017 is the year where we're going to spend $217 million on renovations as a country, which is a number that actually topples the previous high, which was set all the way back in 2006. That was the old apex. We are in a brand new world because now homeowners and home buyers are already realizing the simple matter of the fact that there's an inventory problem out there, and renovation are the way of being able to actually mediate those particular problems. Now, for those of you that may not know, let us get into a quick definition of what the actual program is. The HomeStyle Renovation Loan. If we're going to go by question number one here, what is a HomeStyle loan? A HomeStyle loan is a mortgage product, obviously a Fannie Mae fixed product, that allows allows a borrower to simultaneously pay off existing mortgage debt if a refinance, or pay the seller the purchase amount if it's a purchase, and simultaneously also pay for renovations being made to the subject property, all at one time. So with the HomeStyle Renovation Loan, you are not setting up a borrower for the normal perm, the construction to perm financial structure. This is one loan in one single close that is going to simultaneously pay the seller or pay off your existing lien, and then also simultaneously finance the cost of making the renovations to the subject property, all in one loan, all in one closing, no conversions or anything like that to follow. It is one simple process for your borrower. Now, the way this works, the way that we're able to finance in the cost of making renovations to the property, obviously we have to set our sights for evaluation of value on the subject property much differently. So we don't do an appraisal that just basically surmises whether or not the property is worth the for sale price. No. What we are looking for is an appraisal that is going to factor in the renovations being made to the property and assess its value post renovation, so that we know the property will be worth at least what the borrower is putting into it, if not more than that. So that's the basic crux to what we are doing here. We have to go into a time machine and go into the future and appraise the property that will be, as opposed to appraising the property that is. Now, even though it sounds dramatic or really cool to say that we're going to do it with the time machine, what we really do is that we take all the expositional pieces that explain the renovation, which would be either a bid or a consultant's report. We use those documents to describe to the appraiser what the property will be in the future, and then the appraiser uses that information to appraise that future property if it were in that neighborhood right now. Right? That's how that simply works. Now, once we do that, we then look at the actual renovation part of the loan, and we take the LTV that's being applied. So let's say if this was a single family property doing a maximum LTV of 95%, we're applying 95% of the LTV to, we're applying a 95% LTV to the purchase price. We're also going to apply a 95 LTV to the renovation cost. So if this borrower were purchasing the property at $200,000, what we would wind up with is a purchase price of $200,000 And at 95% LTV, we'd have a loan amount of 190. But let's say that borrower this is a home style loan. They're also doing a $100,000 renovation to the property. At that given point in time, we're going to take that $100,000 and also apply 95% LTV to that. So now we have 190 plus an additional 95, which is then going to take us into the range of having a $285,000 mortgage amount. It is really that simple. Now, this whole thing is predicated on obviously the property being worth at least, at the very least, the $300,000 that's being levied into the entire project. Okay, so that's how that actually works. Now, we've mentioned time travel, contractors' bids, and using numbers the way we normally do not use them in the mortgage process. Oh my God, this sounds a little bit difficult, right? Wrong. It's actually not very difficult at all. We do not like to overcomplicate this process. In fact, the one thing that you're going to hear us say as a mantra around these parts here in Redmond is that every single one of our home style loans is no more complicated than actually closing a regular Fannie Mae 30-year fixed mortgage. All of our credit underwriting guidelines remain exactly the same as what you would see in our standard Fannie Mae, guidelines. The only difference here, we have to also validate the construction process, and that's really a 3-question process. What you need to know to do a home style loan over doing a regular Fannie Mae loan is, what are you building? How much will it cost to build it? And last but not least, who is the contractor making all this work happen? Those are the 3 things that you need to actually take care of. And then we will, of course, use documentation to document the answer to those particular questions. All right, so that's not overly complicated. The standard loan process, 3 additional questions. And last but not least, you look at this slide, you have to wonder, so I hear that these things are at least difficult to get done. And the answer is, well, some people make it hard. We're not those people. Our running average in terms of being able to get these loans actually cleared and funded, we're running just over 30 days from the time of submission. Now, granted, these loans take a little bit of extra seed work to get done so that they can be properly ready for submission. But once that loan gets here, we definitely have everything that we need in place to make sure that you can clear it and close it in a very reasonable amount of time. So I would say 90 days, you've got to be doing something wrong there. And more than likely, you will have us chasing you to try to get you to clear it and get that loan out of the system, as opposed to it just kind of languishing and waiting around here for you to really be able to close it. All right. Now, I mentioned we have an inventory problem. All right. And that problem really manifests itself to your business partners, loan officers, your real estate agents. All right. Your favorite class of referral partners, the ones that we all can't live without, except we all wish that we could live without them. But they are a necessary evil, and we have to work with them. All right, they are the people selling homes to make sure that our purchase business actually flows and makes a little bit of sense. But their most common problem is that they either have clients that, simply put, cannot afford anything that they actually like, and all the property that they like, they cannot afford, which means that the properties that they can't afford, they don't like, and they wind up shopping with them endlessly as they are looking and looking and looking without being able to successfully put in an offer on any of the properties. But that's not the only problem, because that's the traditional problem. The new problem that we've had ever since the mid-2000s, there's inventory out there. Hey, they have money, they see things that they like, but every single time we go to offer a bid on a property, once it officially hits the market, 10 other competing offers come in and we never win. So it sounds like if you're a real estate agent, you're caught between a rock and a hard place in this marketplace, and you really don't have any means of being able to kind of get around it. But there's a solution. There's a definite solution, and renovation lending is a solution to this problem. It's just not the most common problem, not the most common resolution that you would imagine. Let's talk about scenario number 1. All those properties that these borrowers can't afford, that are just a little bit less desirable, a little bit older, a little bit less attractive is a word that we can use here. But all those dirty dogs, those ones that are just too small, too dated, don't have the right bed bath count, are missing some critical element that they need to be able to capture modern appeal. All those properties could be absolutely valuable and positively radiant possibilities if you made renovations to those properties to bring them up to the actual appeal of all of the properties around them. All right, now how do we actually validate this? It's very simple. You take a look at the actual neighborhood, and let's say this borrower has caviar taste. They have a $350,000 budget, but they like everything in the $600,000 neighborhood. And there's one property in that neighborhood that they can't afford, but obviously that's not the one. It's just the one that they can afford. It's smaller. It has everything wrong with it that they could possibly like, they could possibly dislike. But the absolute benefit is the neighborhood and the surrounding area is gorgeous. The schools are incredible. It's exactly where they want to be in terms of being close to work and other relatives and amenities. It has everything going for it except for the interior of the property in and of itself. And even at a significant discount, it's just too difficult to have the one ugly house in a beautiful neighborhood, and your borrowers, they can't stand it. But enter the HomeStyle renovation product, because now we can start talking about the simple idea of let's make renovations to this property to bring it up to the neighborhood. Let's put a $100,000 renovation down on the property so that it does look just like the house across the street, or the property a little bit further up the road. Let's make it comparable to everything else in this particular market. And in most cases where borrowers are reluctant to separate themselves from their own reserve cash to make the renovations, what you'll notice is that when they see the ease of use of taking that additional $100,000 investment into the property, but only needing $5,000 out of pocket to make the entire $100,000 renovation happen, it is a much easier process. Now for that other problem, multiple bids. Every single house that goes up on the market is just a nightmare of not having your bid being selected as the lucky one. The only thing we need to do there is stop shopping in the most complicated and overcrowded market, and let's look at some of these more dated homes. There's far less competition. There are less offers to be worried about, plus not to mention an actual interested and emotionally invested owner-occupant is a more attractive offer than an investor, especially when the seller knows financially that this invested owner-occupant has a solid plan for the property and has all this financing lined up to make sure that this transaction will be successful. It gives that seller all the confidence that they need in the world to move forward with that particular borrower instead of just about anyone else. All right, so the HomeStyle as a program, definitely something that helps your real estate agents. And if it helps your real estate agents, loan officers, I am telling you that it helps you become something more than just a simple commodity that they pass a deal to every once in a while. It makes you more of a partner, someone that is solving one of their needs and is helping them make more money, and in return, they should be offering the exact same to you. And by offering that to you, I want you to realize not just beyond just helping your real estate agents, this is also going to help you and your client base, because you, as a loan officer, instead of sitting there and only being able to talk about LEs and fees and increments of a rate, it's going to allow you to talk about something that is actually meaningful and impactful to your homeowners, and that is creating their gourmet kitchen. Finally giving them a sanctuary and an ensuite that is spa-like and comfortable, that gives them that chance to just shed all of their stress. These are things that people value more than money. And by giving them the ability to create these things in their own lives, in their homes, and not just vicariously by watching HGTV on Friday and Saturday night, by making this a reality, and by making this a reality that is financially responsible, you will go from being just a commodity to them as well. You are now an artisan. a professional. You are someone that deserves to be paid, and you are a genius that applies your skill very well and gives them answers that go beyond the standard bearer answers that they're getting from just about everyone else. Now, for anybody that is sitting here listening to all of this and thinking, hey, you know what, this sounds very familiar. It seems to be very familiar or very similar to the FHA 203K. You're right, it is. But there's an important difference here. This is a conventional product. So that gives the borrower some additional flexibility in terms of being able to only finance at 80% and avoid the entire question of MI. Because for many borrowers, MI is not something that they actually want. So that is actually a very good thing for us here. So let us look at some of the other things that we can do with the with the HomeStyle product as opposed to the FHA. And let's get into talking about different home buyer types. Owner-occupied only on the FHA product, but on HomeStyle, we can not only talk about owner-occupied borrowers from 1 through 4 units, we can also talk about secondary homeowners. And then last but not least, we also have the ability to talk about single-family investment properties on the HomeStyle product. So this gives you a little bit more leverage to talk to as many different types of home buyers and homeowners as possible. Also, in terms of the actual work that you can do on the property, Fannie Mae is much more reliant on the value of the property, so they have removed the restrictions for luxury items. So on a HomeStyle loan, you will be able to put in new features like spas and pools and exterior kitchens, doing all kinds of interesting and beautiful landscaping projects, or anything on the exterior of the property to enhance curb appeal just for the simple sake of matching the whims and desires of your borrower. So it's going to really allow homeowners to unlock their inner creativity and to really make this home their own on both the inside and the out. It is a very, very, very beautiful thing. All right. Now, in terms of getting into the structural elements of exactly what they can do on the inside and the outside of the property, just like with the 203K, we are really barking up a nearly infinite tree. It's almost impossible for anybody to tell you every single possible eligible renovation that can be performed on the property. I mean, the slide that I'm showing you right now, it has a very, very good list, a beautiful list. All right, it's wide, it's various, but it doesn't cover everything. There's no such thing as an all-inclusive list for these products, and you can see here everything in between, minor interior work like flooring, painting, and windows, all the way up to massive additions, replacing full mechanical systems. You can literally do nearly anything on the interior of a property with a HomeStyle renovation loan, just as you can with the 203K. But in order to help you understand how everything works, let us actually talk about the things that you can't do, because that's a much easier, more defined set of things to discuss than the other topic. So let us take a look at what you cannot do. First, while the Fannie Mae HomeStyle is a product that will allow you to finance kitchen appliances, I want you to realize there is a limitation. You have to be doing a full kitchen refinance in order to finance the cost of kitchen appliances. And whenever we're having the appliance discussion, we are limited to specifically kitchen appliances, which does not include washers and dryers. Our borrowers will have to actually go out and purchase their own washer and dryer. Now, it is possible to have the borrower purchase the washer or dryer separately and then have that installed as part of the renovation work. That can be accommodated, but we could not actually finance the cost of purchasing said washer and dryer. Realize that that is one of our limitations. Another limitation, we cannot create commercial spaces. All right. So if your borrower is any type of work at home profession where they actually see clients in their home, we can't create waiting spaces. We couldn't, put in, an internet terminal for them to run a POS system. Nothing like that. All right. More commonly, things like, hey, can I have a lift in my garage? What's your profession? I'm a mechanic. I am sorry, that will not happen. All right. So those are things that we definitely cannot do. Something that's a little bit more practical. We cannot create freestanding accessory units that are totally detached from the subject property. All right. Anything that we put up as another secondary structure to the actual, on the property itself, must be attached to the main dwelling via breezeway. All right, and a breezeway is really just a covered walkway, but something has to actually connect it to the main structure. So realize that. All right, so the 203K product recently has made changes where we are allowed to put up detached garages. HomeStyle still does not allow that. All right, so no detached structures of any kind. Everything must be attached via breezeway if it is erected. Now, let's talk about LTVs and basic program eligibility. Now, I mentioned that we can go owner occupied 1 through 4 units. Let's take a look at the LTVs that we are able to use when doing so. So on an owner occupied single family, we can go to a 95% LTV, both purchase and refinance. If it is 2 units owner occupied, we can do 85%. And if it is anything over that, so that's 3 or 4 units, we can do an LTV of 75%. Now, on owner occupied, all of those LTVs are both for purchase and refinance transactions. Look at them both being exactly the same. Secondary home owners, whether purchase or refinance, this is limited to single family, but we can do an LTV of 90%. That is very much a fantastic thing. That literally gives many secondary homeowners that actually put money down, that bought with equity, the ability to do full renovations on their secondary homes without really making any out-of-pocket investment. That is phenomenal. So this is something that you can definitely use to sell, especially now that we're in these winter months and people are going to start looking to make more use of those vacation properties soon, maybe even gearing up for light rental season in advance of them actually making their own personal use of that property. Sprucing it up, being able to make it competitive with all the new properties in the market or the recently renovated definitely helps being able to afford this property year round. Last but not least, let's talk about the investors. I mentioned that we could help them, and help them we can. We can do an 85% LTV purchase on a single family investor purchase. We can do a 75% LTV on a single family investor refinance. All right, now before anyone asks the question on the question panel, no multifamily investor at all. There are no exceptions. It's a Fannie Mae rule. They just do not allow it. If they ever soften on that, believe me, I will let you know, because I would love to be the first person to crow about doing this. Now let's talk about credit criteria. For credit, anyone that works with us extensively knows we do not make any overlays or any other uses on top of DU. The same thing is going to go for our HomeStyle files. So we don't do any manual underwrites. But that means that all of the actual credit conditions that you get from DU regarding credit, income, assets, and their documentation, we will absolutely follow to the letter. All right, the only thing that's even a remote overlay, by us, is that if you happen to get a DU accept on a score under 620, it's not an automatic approval for us. All right, you basically have to make sure that your credit score is at least over 620. However, good luck to you if you're actually trying to get DU to take anything below that actual 620. All right, now aside from borrower eligibility and credit, you also have to realize there are some property things that we need to discuss as well. And that's what this slide is all about. Now, we've talked about owner occupies 1 through 4 units. Now, if a property happens to be a 5 or 6 unit property, we can do conversions down to a 4 unit or below. So anytime that we're looking at properties like that are a little bit complicated, I want you to realize that the final condition of the property is what we are actually locked into, not where the property starts. So it could start as a 6 unit, but if the course of making this renovation work, if we're going to drop it from a 6 to a 4 or a 3, then absolutely that property is going to be HomeStyle eligible. All right. Single family properties that are second homes, absolutely usable, even when they're condos. This is a conventional program, so the condo product itself must be at least a warrantable condo. All right. Also single family investment. The property in and of itself needs to have a certificate of occupancy, or something that we refer to lovingly as a CO. Unlike the 203K program, this CO does not need to be at least 12 months old. It can be 2 days old, right? It just needs to actually have one before the loan funds. That is something that we absolutely need to do. But since it needs to have a CO, that means that there are some definite things that we can't do, like new construction. Those are properties that were never given a CO, so it doesn't work. or a property that has been condemned. The CO was actually invalidated by the act of condemnation. That also means commercial properties, unique properties such as churches and lighthouses. Those are things that will actually never be given any type of CO. So therefore, we cannot work with them with this particular process. And now that I've used the word process, let us actually start talking about what that process is, right? Because you need to know how this process stacks up against the normal process, because you have 3 big questions to answer in order to get this loan ready. And we should begin the conversation talking about that. Now, with these 3 questions, the first person in the loan that you're going to deal with really doesn't have a lot of influence over 2 of the latter questions, but the first one's really all about them, your borrowers. Aside from interviewing them about their credit, about their credit and financial situation, you will also have to find out from them exactly what work that they want to do to this property that they're looking at. Whether it's a property that they own or want to buy, you need to know what work they are actually going to do on said property. So the borrower is instrumental in getting that information, all right? Their borrower's real estate agent, whether this was a referral of yours or this is a person that you've actually met through the transaction, the real estate agent is hugely, hugely, hugely important in all of this, because that's going to be the person that's kind of quarterbacking things and dealing with the borrower through these inspections as they bring various individuals into the property to ascertain its needs. But when you need access to the property to actually have the contractor walk through with the borrower to get a bid, the real estate agent is probably the person that's going to arrange for that access to the property so that consultation and visit can happen. The contractor, now this is the person that's involved in everything with these 3 questions. The contractor is of vital, vital, vital importance. Now, I don't want any of you to worry about having to wrangle in the contractors. It is actually not as difficult to do as you would imagine, provided you follow the rules. And we're going to go over what those rules are to make everything very easy. Your contractor has to give the borrower an actual broken down bid that fully describes all the work being done to the property, and most importantly, what that work costs. Now, that sounds like question number 1 and question number 2. What work are we doing? How much does it cost? Yes, the contractor's initial bid is going to be your first assessment of those 2 particular questions. All right. Aside from that, the program-specific disclosures that we have for the HomeStyle have to be completed by the contractor. We're talking about 6 disclosures. 6. In these 6 disclosures, 5 of them are literally print name at top, sign name at bottom. They are very, very, very easy. There's only one that requires any kind of work, and that's called the contractor profile, and that's a 1-page questionnaire that is all about the contractor's business. The contractor is going to complete that 1 page, the other 5 disclosures, send it back to you alongside their insurance and licensing information. That's the only thing you need to do at this point in time, is hold that information for submission with the loan when you go to send it in. That's all we ask you to do. We don't ask you to be an expert in contractor vetting, in or of your own. That is our responsibility. All right, so we will take care of that. There's one more individual that you will speak to in this process, and he also is going to factor in on your 3 questions, and that is the consultant. Now, when I say the consultant, I'm actually talking about 203K consultants. We use the very same 203K consultants in our HomeStyle program as we do with 203K loans. That is for the simple reason of uniformity, their reporting style. Their reporting style is very, very familiar to us. It's very easy for us to pick up their reports and read them without asking a ton of questions. So it makes it very easy for us to remain efficient in our processing here on the back end. So we still use consultant reports. Now, on a HomeStyle loan, the use of a consultant's report is a little bit different because there's a different financial factor. On HomeStyle loans, there's no such thing as a limited or streamlined program, which actually means there is no ability to prepay a contractor ever. So if we have a very small job, and let's say a $23,000 job, without using a consultant, that contractor would actually have to finish the entire job, have the final inspection done by the appraiser, and then receive full payment without getting any money up front at all. It is not a comfortable conversation to have, which is why on our HomeStyle loans, anything over $15,000 with a single contractor, we absolutely require that you use a consultant, so that this way that contractor can get a midstream draw during the job, so that they don't have to finish the entire project without any money coming in. All right, that's something that we absolutely want to make sure that we're taking care of. Now, this consultant, what they do for your borrower, aside from providing those draws at the end, at the very beginning, they provide some very vital services that your borrower is definitely going to need. First is an actual assessment of the bid to make sure that the contractor has come in with a bid high enough to complete the whole job. I know out there, if I took a poll of hands, many of you would raise them if I asked the question, how many have heard of a contractor that suddenly stops in the middle of the job to say, hey, I don't have enough money, I need another $10,000 to be able to do the kitchen the way I told you? All right, many hands will go up. The reason why that happens, underbidding. They intentionally give you a lower bid so that this way you hire them in case you are also vetting them against other contractors. And then once your walls are open, well, now I can go back for the real number. We don't have time to play that game in home style lending. All right, so we need to know that the actual bid is sufficient to get the job done from the very beginning. And the consultant helps us do that by breaking down the bid and looking at the property to make sure that no work was missed and that the numbers actually do make full sense. All right, this is also going to be the person that kind of is the go-between between borrower and contractor. So this actually installs a nice layer of insulation from the borrower. Now also during the work, while everything is happening, the consultant is the person that actually comes out and inspects the job site prior to every contractor draw. All right, so this is the person that if the borrower feels uncomfortable about the level or the quality of work being performed during the renovation, this will be their go-to person. So in all honesty, this consultant really does a lot to kind of help frame everything together, make everything work, because their report is spot on. It's a perfect breakdown of the actual work. It makes the documentation process so much easier. And then moving forward in the customer service aspect, being able to A, verify the bid cost, and then B, being the voice of reason between borrower and contractor, and someone that can, with a professional eye, judge the contractor's work without being emotional, definitely will help move everything forward during the actual construction part. So how do we put all this together? It's the next question, and it's actually a very good one. The process, even though we've been talking now for a good 35 minutes, is not as difficult as you would imagine. So step number one is really going to be qualifying your borrower and getting their basic credit package ready to go. All right, that's always going to be your number one. But your number two item is going to be beginning to document the renovation and starting with our 3 questions. So number one, defining the renovation plan. What are we going to build? Get your borrower to get out with the contractor and have the property inspected so that they can come up with an actual complete bid for the jobs that they plan to do on the property, and that you have pricing. All right, if that pricing is over $15,000, your next step is going to be contacting a 203K consultant to make sure that we can A, have that bid validated, and then B, getting that consultant's report back, because that consultant's report is just going to completely replace the bid moving forward in the loan. All right. Now, during this time frame, you should also have your contractor completing the home style disclosures. All right. Once the consultant's report is back, we are ready for the final step, and that is basically making the final run through all of our paperwork. All right. And up until now, we've been working on estimates. Now that we have this SOR back, we can do your full SOR. Sorry, not your full SOR. We can do your full maximum mortgage worksheet, which is basically the sheet that really determines our loan amount and helps us do all of our calculations. In the beginning of the process, we're going to estimate one because that's all we can do. But now that we have the SOR back, we can do it in earnest, I should say, and have the final one ready. All right. All of your disclosures can be fixed or adjusted at this point in time, but most importantly, you're ready for submission. You have everything that you need to get this loan together. You have your credit package and you have your contractor validation package for renovation as well. And your file can go in and you can order the appraisal. So this really gets you going. And from this moment forward, this is when you're on the 30-day clock to really be able to come through and look at clearing and closing the loan, because once you get that loan approval back, you're going to be looking at everything, all of your credit conditions as well as your renovation conditions, and then you'll be able to move through them. If we have issues with the contractor for any reason, whether it's just simple things like answering questions about not filling out the paperwork cleanly, any kind of conflicting information, anything that needs to be sorted out, we'll be able to suss out all of those issues right then up front, as opposed to finding out that there's an issue with the contractor about 3 days before you intended to close the loan, which is not comfortable. All right, so by following this method, this allows us to give you a clean process where you can move through this thing very efficiently and, most importantly, get to the closing. Now, once you get that CTC, and we are scheduled for closing, and we are at the good part, I want you to realize and rejoice. Once this loan closes, my friends, loan officers, you are done. There is no more work that is required of you. In fact, everything that you're doing from that closing point forward is for the benefit of your relationship with that borrower, in case you want to finance with them, additional, they may come back to you with more referrals, or to refinance them in the future. Everything at this point is about that particular relationship. But in terms of this loan, you're going to be paid out like all the other standard mortgage costs and fees on the day of settlement. All right, so the funding day is a day when you rejoice and you are paid. Okay, now the borrower at the time of the CTC, they're going to get a call from my renovation concierge department. These are the people that are going to walk them hand in hand through the renovation process with us, because they stay with us this entire time. We don't move their loans on until the actual work on the property is done, and the people that they're going to deal with until that time are all Remin employees. Okay, they're all homegrown Reminites that are here. All right, so that is the beautiful, beautiful thing. But this means that everything regarding the renovation goes through us. If they have to make any changes, need to process change orders, if all of the actual inspection reports from the consultant, everything comes through us. The borrower actually winds up with a personal contact for one individual that will be their draw specialist, and they get an email address to correspond with that person with. Now, that particular email address is a departmental email address that goes to everyone in the department, because we can't take the chance on somebody having the flu, being sick, or out of the office for any reason, and then having any important communication about the project kind of going unnoticed or falling through the cracks. All right, that is the reason why those things are actually like that. Now, in order to get everything rolling post-closing, some of the biggest questions that people ask are, the time frames, how long things take. Typically, it takes us about 10 days to get the actual repair escrow funds back from settlement. All right, so we don't allow any draws within, a 10-day span from closing. The contractor isn't allowed to start any work on the property until the actual funding date. All right, no work can start until that funding date. Certainly, he cannot request any draws until we actually have the money here in-house. So even if we started a draw, we would not be able to actually send the check until we physically receive the funds back from the settlement agent. Now, the actual time frame for processing a draw is very simple with us. The consultant actually sends us the actual draw inspection report. It actually has an amount on the draw for the draw amount. All right, it is clearly labeled. Also labeled, it is a 10% holdback. We hold back 10% of each payment to the contractor, just to make sure that on that final check, there's at least a significant amount of money left over, so that this way they finish the project strong, as opposed to scattering their people out chasing other well-paying opportunities. All right, that is the reason why that is done in particular. Each and every single project has a maximum number of draws set at 5. The number of draws for that specific project will be set on the SOR. So you're going to know how many draws the borrower has right up front from the very, very beginning of the actual process. All right. It takes us let's say, 24 to 48 hours to process the upfront paperwork, and then the actual draw request is then sent to accounting, and they mail out the checks via 2-day air. So 4 to 5 days is our average turn time for draw requests, and not the several weeks that you've probably heard about in horror stories regarding other lenders. All right, so once that actually, once we go into the actual post-closing life of the file, you, my friend, you are done, but we're just getting started, and we're going to go through everything with the borrower at this given point in time. Now, how much time does the borrower have to get the work done? Our standard window for finishing work on the project is 6 months, okay? But we do have more time than that available. Once you get to the 6-month mark, the contractor, the borrower, the consultant, they have to actually request 30-day extensions, which we can then issue, all right? But we want to keep tight monitoring of the situation, just to make sure that we are, in full understanding of when the actual new estimate date of completion is going to be. All right, that is very, very, very important. Okay. Now, Another thing that we must also discuss here, funds at closing. There are zero in HomeStyle. I mean, absolute zero. There's zero prepayment to the contractor ever allowed. So there's no upfront draws of any kind. However, we can pay 50% for custom materials directly to the supplier at the time of closing. All right, so we can do that. So if there are custom cabinets ordered or something that has to be custom manufactured, we can send a 50% deposit directly to that source. We can't fund that money or funnel that money through the contractor, but we can send it directly to the supplier actually fabricating that material. All right, that's an important thing that we have to discuss there. Now, in a nutshell, that is essentially the program. I've promised you a good number of things. I've promised you some transparency. I've promised you a simplified and really logical process. But most importantly, I'm promising you support. By working with us, you're definitely going to be paired up with an AE that's going to be there to answer all of your questions about Remin and kind of be that conduit through which you can flow all of your questions and all of your contact with the company through this one particular person. But beyond that person, you have several other people that help. Many of them have internal assistants here in this office, right outside of my office door. I actually sit in a little compound in our office in that area where all the AE assistants are. They are fantastic people that can take care of a lot of your common questions regarding systems and paperwork and different things that are all specific to Remin. They are here. All right. Also, in this compound, we have an account manager specifically for renovation files. So if you have a difficult approval or just have an approval you don't understand, he can absolutely take a look at your renovation conditions and help you break them down and take a look at the documents that you're submitting to clear set conditions to make sure that they will be sufficient. And if not, he will help you retool them to get to the point where you can get that thing cleared without you having to wait, submit, have the underwriter look at it, and then kind of go back and forth. He's definitely going to be somewhat of an expediter, someone that can actually help quickly move that process so that this way is a little bit easier for you to get things through. And that is our process. Oh, you know what I forgot? The last part of that puzzle. You also have me. I'm David Richardson. I'm not just the person that you're going to speak to, today on this webinar call, but as your loans are lining up and you're trying to get them in and you're trying to understand how to get your disclosures done, or if you've never seen an MMW before and you desperately need to know how to get that taken care of, how to structure your loan and your LOS system, your processor's never seen one before and no one knows exactly what to do, I'm here to help with all of those particular items. All right, we want to take the sting and the mystery out of doing these loans, which is why we've renamed the webinars as Decoded. We want to take the mystery out and we want to put in a sense of familiarity because we just want to show you that this is literally doing more of the same. It's just doing it with a couple of wrinkles and a couple of new twists, but we're here to kind of instruct you through all of these new dance moves to make sure that you can hit the floor like a pro. All right, we want everybody to look like they are young, gilded, and free and able to do all the things that they've always dreamed of. So that being said, I want to thank everybody for coming to today's event. I understand that there may be some questions that I have not fully covered in the actual course of the presentation. So what I will do at this point in time is take a look. Let me see if there's anything scheduled on our webinar channel directly after us right now. Let's see, and there is not. So I definitely have time to do a question and answer session and taking a look at some of the questions that we have here that have accumulated that I have not answered to make sure that everybody here on the line definitely gets answers to their questions. So let me scroll back up toward the top here. And let's see. All right, now that was technical difficulties. That's not really a question for us. All right, now Michael's asked the question and he says, do we need certification to originate and market this product? You don't specifically need any type of certificate from us. You're definitely going to get a lot of training from us to make sure that you're not making common mistakes that will slow you down. Okay, we definitely do not want to see that happen. So I would definitely suggest setting up a conference or training call with us through your AE so that we can make sure that you are mentally prepared for everything that you have to do to get the loans done, but it is not required. But if we do see you making mistakes, there's going to be constant starts and stops as we are correcting various mistakes that you're making. So the easiest way to avoid that is just do a training session with us at the very beginning of the process, just to make sure we can alleviate those mistakes in general. All right, Michael? So that is our first question answered. Let's see. What is the minimum amount of renovation? Can you add a pool and a spa? That was a question by Rose. There is truly no minimum amount of renovation work that can be done on a home style loan. However, there is a theoretical maximum, and that theoretical maximum is 50% of the after improved value of the property in and of itself. So let's say if you have a property that is going to be worth $425,000 on the appraisal, right? Let's say if you have that particular property, all right, you will have a maximum limit of $212,500 that can be in the repair escrow. Now, that does not mean that that's the cap for the loan amount. That's just the cap of what we can spend on renovations for that particular property. All right, so you have that to consider, but that is all. All right, let's see. Our next question comes from Todd, and he says, if an investor has already bought the property and started work, and he's done this all for cash, is it too late to do one of these loans? Actually, Todd, it is not too late. The only thing that the investor would have to do, stop working on the property right now, allow us to get a consultant out there to take a look at what's needed to be done to finish the project from that point moving forward, and then we could finance all of the work going into finishing the project. Now, we would not be able to go back in and finance work that was already done, all right? And that's why we needed to make a clear beginning point for the renovation process through the loan, okay? Now, if that's unclear at all, Todd, you can send me a follow-up question and we can talk through the scenario because it sounds like you have something particular. But no, the general answer here, it is not too late if they've already started the work. In fact, a lot of our home style loans are people that tried to do cash out refinances, ran out of money, and then they just need some way of being able to finish the renovations they started to their homes. And this is a great product to do that with. Our next question comes from Carmen. And she asked, I'm trying to add square footage to my home. I love my current rate. Do you require for me to refinance to get this product? And the answer to that question is an absolute yes. All right. This product works by replacing your existing lien. All right. So it is not a secondary mortgage. It is definitely a first mortgage project or a primary mortgage product. So it would require paying off your current loan. All right. Now let's see. Our next question is from Chris. And based on my experience in the Southern California market, it looks like the amount of consultants in my area is limited. There are limited quantities of consultants, and we work with HUD all the time to try to restock the pool of consultants as they become either busy or unavailable or sometimes aging out and no longer working. We do have for the home style a private alternative to these consultants, and we use them as a secondary source, but their reports are a little bit more expensive, which is why they are not the primary. So speak to us in regards to items like this. If you are running into areas where the consultant pool is kind of limited, we do have some other alternatives, and we will speak to you about them at great expanse, on a case-by-case basis. But don't worry, if you cannot find a consultant initially, don't feel that you're stuck. We do have some other options for you as well. Okay, our next question is from Craig, and his question is, if someone is purchasing a home and wants $50,000 for renovations, how do we know that a house will appraise $50,000 higher than the purchase price? Craig, this is a quite simple question, and this question goes all the way back to the simple idea of we have to understand the market that the house is in. So you take a look at what the borrower currently owes on the property. Let's say if they owe $350,000, and you're looking at this particular neighborhood, and the median home value in that neighborhood is $350,000. If they're mortgaged to the hilt already, and there's nothing worth more than that in the neighborhood, then obviously, the answer is going to be no. All right. But there are some simple things that definitely help with being able to create value. But first, if they purchase the property by putting money down, there should be some installed equity already inside of the property. If they've owned for a number of years and have paid the mortgage down, to any degree, there's another opportunity to create that. Or simply put, if they were, the mid-level property or a mid-level property in this particular neighborhood, and there are some definite properties of similar construction types that are, superior, that are worth more, then absolutely emulating those properties will create a situation where you will yield yourself that extra value. All right, but that's something that we really have to discuss on a case-by-case basis. So that's where you kind of get it if you don't. So reach out to me separately, Craig, and we can definitely talk about that in at great length for whatever you need. All right, Art has asked the question of how do you find a consultant? Quite easily. Finding a consultant is as simple as being able to use a web page. So let's take a look at something very quickly. I'm just going to bring up my web browser, and of course, when I go to open it, it opens up on another monitor. So hold on, let me drag this over here. All right, but finding a consultant is very easy. You go to our webpage, you go to this links tab. And then after you hit the links tab, you scroll down to FHA, and the very first link is the 203K consultant search, which goes to HUD's webpage. You just basically put in your state information, and everyone that's on that list is someone that the borrower could definitely hire. All right, let's see. Michael has another question, and his question is there an actual max loan amount? The max loan amount is going to be the actual conforming or super conforming limit. So that's the actual maximum mortgage amount, the same as every other Fannie Mae loan. Let's see. Our next question comes from Manvinder, and their question is, how about when a client uses more than one contractor? There are definite situations where borrowers use more than one contractor. Each and every one of these loans has the ability to be somewhat different than any other one. So we will definitely talk about different strategies and different things that are, that are happening. Now, I will tell you this much. If you're asking the question to try to circumvent the possibility of using consultants, not a great strategy. All right. Trying to get around the use of consultants is never actually a worthwhile process, because you're doing your borrower more harm than good, and more than likely you're putting them in a situation where now the consultant's report will just be needed later, and then they still have to pay for it. So it is not a great idea to try to walk into this by thinking, hey, let me try to get around this consultant thing. Embrace the consultants. They're definitely worthwhile, especially considering there is never any prepayment. And I will tell you this, a contractor that is not going to get paid when they're expecting upfront money is not a pleasant thing to work with. All right, there's nothing pleasant about that at all. All right, let's see. Our next question comes from Brad, and Brad says, Fannie Mae HomeStyle has a streamlined option, correct? Maximum loan amount for HomeStyle per guidelines, I see $35,000. This is correct. Not quite, Brad. There's no such thing as a Fannie Mae streamline. That's something that is in our guidelines because we made it up. We did, because we're trying to make something that seems more familiar, but it's not an actual thing. It's a thing that we have made. If you try to use no consultant on, let's say, a $25,000 deal, we cannot pay that contract until the work is done. Or if we get lucky enough to have an appraiser be able to do a midstream draw during the work to get that contractor money as work is being completed on the property. The problem with an appraiser doing that is that the appraiser has to be able to gauge completion of the work, which not necessarily is an appraiser's strong suit. All right, Brad, so if you need to talk about that specifically, reach out to me separately. It's a little bit of a particular issue, but realize the answer to your question is essentially yes and no. All right, there's no such thing officially as a Fannie Mae streamline. That's something that we've kind of custom manufactured here on our own right, but the ability to do one of those, you still do not gain the ability to prepay the contractor, which can leave you in a little bit of a pickle. All right, so that is a much larger question if you still have questions regarding that. All right, let's see, our next question from Michael, and he states, if you have a home that has roughed-in plumbing and unfinished walls, can we do a home style? That all depends on whether or not the property has a certificate of occupancy. If it has a CO, absolutely. If it does not, then we cannot. All right. If the property was, does not have a CO for any particular reason, the only other alternative that you have is possibly asking the county or the municipality for a temporary CO, which would allow us to actually work on the property. All right. Now, not all locations or municipalities allow temporary COs, so that's something that you may not be able to actually take care of. But again, since these loans tend to be different from one transaction to the next, depending upon varying factors of location, government boards, the actual characters at play, this is something that we can talk about literally on a case-by-case basis. All right, Marco, but if any more questions regarding that, please send them to me separately and we can discuss at length. All right, Chris has asked the question, are credit reports from the contractors required? And the answer is no. We're not here to gauge the contractor's credit. We gauge the contractor based on whether or not he has fraud under his name. So we still ask for a social, but not necessarily a credit report. Patricia has asked the question, could you please discuss your interest rate and fees? I will tell you this, rates are definitely a little bit higher on home-style loans. They're a little bit more risky. I would tell you that probably the max rate that you're going to see on a home-style loan is probably just over 5%, maybe 5 1/8, 5 1/4, but typically the rates are cresting around 5%. That's where they are. I don't necessarily deal with pricing as much on these loans, and I will tell you borrowers are far less price sensitive on these because you're comparing financing renovations to all of their other means, not a primary mortgage, and those other means are excessively high. The closest thing they could get is doing partial financing with a HELOC, and that would still give them a rate of 8 or 9%. And then everything else, whether it's unsecured personal loans from a bank or credit card, everything else is in excess of 12%. So 5% typically wins that conversation. And I don't see any other questions below Patricia. So that relatively takes us to the end. Oh, wait, there's another question from Brad. And Brad, literally what I have told you about the quote unquote Fannie Mae Streamline option, you took that from my guidelines. We made it up. And if you try to do one without a consultant, Fannie Mae doesn't give us the ability to prepay that contractor. So the question is, can you convince a contractor to do $30,000 worth of work without paying him? I don't think the answer to that question is yes. In most cases, the answer will be absolutely not. This is a much longer question. It's just come in from Marco. So just when I thought we were done with questions, we've just gotten a couple more. Hold on, let's take a look. Okay, Marco's asked another question regarding upfront funding to a contractor. Just like with any standard 203K or any large project, no, the contractor is not going to receive any money from us upfront. Okay, they have to be able to start the project on their own. Now, what the contractor is getting from us, we have all of the money to complete the entire contract held in a true escrow account, which means they have a guarantee of payment. They just need to be able to display to us evidence of completed work. All right, we don't give them a prescribed schedule for draws. The contractor is actually able to call for the draws whenever they would like to use one to get money into the project. Right? It's a system that actually works out fantastically well. But what this means, if your borrower wants to use the local handyman as their contractor, absolutely not. That person does not have a mature business. They have zero credit. So no, they would not be able to take on one of these projects. We are absolutely discriminating against people without real contracting business. All right, that is absolutely the case. All right, Marco, so yes, the contractor does need to have the ability to start the job on their own. All right, that is something that is absolutely, positively necessary. All right, and now I believe that was our final question, not unless something else pops up. I don't see anything else popping in right now. It has been an hour with all of you. I really appreciate an hour of your time. I know this is the holiday season, and this is prime lending time. This is the last chance to get loans in before the holiday, so I appreciate everyone spending this time with me this afternoon. Again, my name is Damon Richardson. I am the renovation lending specialist here at Redmond Wholesale. If you have any questions that I was not able to get to, or if you needed expanded answers on anything that we discussed here today, please reach out to me. My email address, drichardson@redmond.com. Very simple, very easy. And I promise you, we have a very even-toned, not hoity-toity process. We like to make everything as normal and as real as possible for our clients and our associates. So please reach out to me should you have any other questions. I thank you all again for showing up today, and I look forward to working with any and all of you in the future.